All right, guys, I want to do a quick video on and break down a universal life policy. So, a universal life policy, and this is the hardest one to understand. Universal life policy, all this is an annually renewable term with cash value laid over it. And the cash value is there to keep the premiums level over the life of the policy. Whole life's no different. A whole life, basically the same thing. It's just guaranteed. Universal lives just aren't guaranteed unless you have a guaranteed UL. But we all know that people take out universal life policies and they're paying a premium. And let me go into the presentation that we show everybody. So everybody's showing a presentation and we're getting down here. And this is what most people learn off of, okay? So when we explain universal life, I'm not sure how everybody explains it. I explain it in a way where it sounds like whole life, but most people say, hey, the cost of insurance is in the background. You start off paying a certain amount, but every year the cost of insurance goes up. But as you're paying more than the cost of insurance, every month the cash value goes up. Now it peaks when what you're paying equals the cost of insurance, and then it starts going down. Now the cost of insurance keeps going up, so that's why you're losing money in your cash value because it's taken from the difference. So how does that work, guys? So I made a little note, did a little graph, and this is how it works. So let's just take the example, and I did this before I did this illustration. I'm gonna put it all together with an illustration. Let's just take an example of somebody took out a $100,000 universal life policy. They're paying $100 a month. And let's just say that comes out the target premium. Everybody knows it's run a quote off maybe Forrester's. You get 3 different quotes. You get the minimum, you get the target, and then they call it the smart solve. So I guess that's the max they'll allow you to put in per month for that face amount. So let's just take a common one. People always try to get the target. What does that mean? That means, okay, we're paying $100 a month, and here is the $100 a month premium, which isn't going to change. They're going to assumingly pay that forever. We've got the cost of insurance. Let's just say, for example, it starts off at $30 a month the day they took the policy out, and doesn't have an age, but let's just say cost of insurance is 30 the year they take it out. So the cost of insurance, guys, and there's also other fees associated with it, but the cost of insurance is one of them. And this is basically the amount of risk the insurance company assumes to insure that person at that age for that amount. All right. And then it goes up every year, just like an annually renewable term. So if you got an annually renewable term, which annually renews every year, it's going to renew and they're going to charge you the cost of insurance every year. So it goes up every year. So that's why this is basically an annual renewable term with the cash value. Now, let's say, the fees, the cost of insurance, everything's 30 a month, and then they're paying $100 a month. Well, over that first year, they're going to net about $70 per month over the first year. Now, we all know the cash value doesn't start until year 2 or 3 on these. So, but just for this purpose, let's just say every month they're gaining $70 a month. All right, so that's why the cash value goes up in the beginning. And let's say the next year it goes to 33. All right, so they're still gaining 67 a month. And let's say it goes up and up and up, and just say here it's $50 a month. So they're still gaining $50 a month because they're paying in 100. All the fees and the cost of insurance is 50, so they should net gain about 50 per month that year. So guys, an interesting thing happens right here. All right, this is where the cost of insurance equals the monthly premium. This year, and I moved this graph over to edit something. It should be about right there. So this year, they should gain no cash value. It should net equal 0. All right. So that year, whatever age they are, that's when on the graph we show in our presentation, that's when it peaks and then it starts to go the other way. So now these highlights represent gaining cash value, but the older you get, the less you're gaining per year. All right, so it goes up and then it starts to go down. Now, the cost of insurance is not linear. All right, it's more hyperbolic, parabolic, hyperbolic, not sure. It goes up more each year. just like when we try to get a quote for whole life, the older somebody is, the harder it is to beat a rate because the price goes up a little bit more each year. Okay, same thing here because you're getting closer to that magical age where people pass away. So they're going to charge more and more each year. Okay, so the cash value goes up quicker in the beginning and then slows down, but then it's going to go down faster and faster each year. All right. And then you can find the cost of insurance table, and it's a decimal based on the amount of thousands they have in the policy. If the carrier won't review it and won't give you the number, you can calculate it. But the main thing is showing the client, hey, look, this is going to go up more and more each year and go up quicker every year you get older. So on this particular example, let's just say, as the cash value runs out and it runs out faster and faster, this usually lasts about 75 to 80. And that's the target premium. If you run a quote on, just say Foresters, and you do the target, they're usually about 80 to 85, depending on how old somebody is when they start. All right. And then there's two main types of universals. There's index universals, and then there's like a Foresters. Foresters issues, and they can change it every so often, but they say, I think right now it's about 4.55%. So they say, hey, we're going to give you 4.55% on top of what your cash value is every year. And I've seen it go up, I've seen it go down since the years I've been doing this, but they're giving you an interest rate on your money every year. And I think it's based on how they're performing and the current interest rates on the market, but that's adjustable and they adjust that. All right. Whereas an index universal life, take for example, if you have a Transamerica and you're in the S&P 500, it's going to give you what the S&P 500 index did. Now there's a cap and a floor. So if you're, as long as you're between there and the S&P 500 is between there, you're going to get whatever that number is point to point, year to year. Now, if it's over that, then they're going to give you up to the cap. They're going to take the rest because on the downside, you can't go below, I think it's 0.75% right now. So as long as you're between there, you're going to get whatever's between there. You can't go higher, you can't go lower. But that's how they give you a credit on the interest credit on your money and your cash value account. So that got into the weeds a little bit, but just for purposes on this example, the cash value goes up in the beginning as you're paying more than the cost of insurance. Once it peaks, it starts to go down, and then it's just whenever it runs out, usually about 75 to 80 on the target example, then they're not going to have coverage because it's going to lapse. So once that cash value runs out, the company is going to ask them to pay whatever the cost of insurance is at that time, which could be way, way higher than what they've been paying, which is the $100 a month. A lot of people sell on that. Now, let me go to another example where, hey, if we're trying to beat a rate or another agent not with our company is just trying to make a commission, and they're like, hey, I can get you 100,000 for $50 a month. Versus looking at a whole life that might be $200 a month. They're just trying to get a sale, trying to get a client to do something, and they're showing them the minimum that they're going to pay. So what I did, I just took the same graph and I moved the line down to $50 a month. What'd that do? Well, that inhibited a lot of the cash value accumulation in the beginning stages of the policy because we moved, see here, it should be peaking about right here. So we moved this line down from $100 a month to $50 a month. So that shortened the amount of time that we could accumulate the cash value, and it increased how quickly we're going to lose it. So it moved that graph down over here about to 65, just say for this example purpose. So that's where you see where people are paying the minimum. It's all that does is shorten the amount of time you can gain cash value and make this lapse quicker. Now go down to an example where, okay, we're looking at not the minimum, not the target, but the maximum non-MEC premium. And let's just say, for example, it's $500. So all I did, I took the same line and I moved it from 100 to 500. And this is not, a perfect graph or a perfect chart, but now we have a lot more time to accumulate in the beginning because the cost of insurance it goes up the same amount over time. It doesn't change, But the amount of money that we're pumping into this above that number, this is where we're gaining a lot of cash value, and more cash value means more interest credited at the end of the year, which means that it's going to make it last way longer. And in this example, it doesn't even get close to going down before that person passed away. So this is an example of a target, the minimum premium, and then the maximum premium allowed for that death benefit for that person. Now, I did run an illustration. Just wanted to show you guys. Running an illustration, I did 45-year-old male. It came to actually pretty close to the example I showed you earlier. So 100,000, 45 years old, just a non-tobacco standard risk class. The minimum premium, look, initial monthly premium, $66 on this example. All right. The minimum no lapse premium, $66. So this is somebody's going to pay $66. I'm going to scroll down to what it's going to show. So on universal life policies, they have to show guaranteed and non-guaranteed. So guaranteed is, hey, look, if the market goes down every year, the rest of your life, we'll give you a 0.75%. Not going to happen, but they have to show it. Now, this is what current rates are, about 7%. That's probably about a 10-year average. So let's just say the last 10 years, if the market continues to do what it did the last 10 years, every 10 years moving forward, at the $66 a month premium, this is what's going to happen. So we'll look at this one, go by, just use historical data to predict the future. So in this situation, took it out when 45 years old. So it's going to lapse because the cash value is going up in the beginning. And then let's see, about year 23, it peaks and then it goes down. And you see how many years it goes up. So it takes, let's see, 22 years for it to go up, and then so it goes up until 67, and then at 74 it lapses. So it's 22 years to go up and 7 years to go down. So guys, you can see how much faster it's going down than it's going up. So once it peaks, you don't really have a lot of time. You have about a third or a quarter of the time left in the policy, because the cost of insurance is going up more and more every year. All right, so that's why it lapses quickly. Now, let's go change the design, and let's just put it at the maximum, where if you're writing IULs for, people that want to max out their cash value accumulation, this is how you would design them. And let's just take a look at, okay, that premium was $66 a month. Let's look at what this one's going to be. All right, guys. Same, I didn't change anything other than I wanted to pay, instead of the minimum, which it still shows the minimum at 66, now the maximum is 475. It's actually pretty close to the situation that I showed y'all earlier. And just to scroll down, everything being the same except for how much we're increasing. So it goes back to, we're going from the minimum, which here was 50, to the maximum to 500, really pushes the policy out. So the other one was lapsing about 74. So now let's look at this one. So, okay, paying in a lot more money, about 8 times more per month, but these are really the only way to design these ULs. I know we have the Mutual of Omaha Smart Solve, and it makes it act just like a true whole life, where it's the cash value equals the face amount at age 100. So that's a good, easy index design, or good, easy design for that policy to make it last just until, like, be paid up when the client turns 100. Still no guarantee, but it's still an easy way to design it. Now this one, paying the max, you can see right here where we go down to 75. We have tons of cash value in here, and go down to 105, and at last the max they do is 121. So this cash value never goes down because we're paying in a lot more, and the cost of insurance doesn't ever have a chance to catch up to what we're paying in. So this is how you design for max funded IULs. So just hope that helps. Hope it clears up any questions you might have had. I know these are the hardest to learn, but if you have any other questions, reach out to me, here to help in any way I can.